let's talk about investment companies. What the heck is an investment company? It's just a container or a vehicle that holds securities. So under the Investment Company Act of 1940, if you notice, a lot of the acts came out, there was the Securities Act of 1933, the Securities Exchange Act of 1934, the Investment Company Act of 1940, the Investment Advisors Act of 1940. The reason that happened is because there's a lot of fraud going on in the before the Great Depression, during the Roaring '20s, that you can argue contributed to the Great Depression and caused the market collapse. And even if you look, I believe Jesse Livermore, there's a famous trading book. If you ever check that out, it was completely, it was kind of the Wild West back then. I think he was pre-1940, but I don't remember exactly. But yeah, so going back to the Investment Company Act of 1940, there were 3 investment companies created. There was face amount certificates, unit investment trusts, and management companies. So face amount certificates are sort of very, very old-timey. They're almost essentially like zero coupon bonds in a way, where I say, look, hey, Mr. Investor, if you pay me $1,000 right now, I will guarantee you as a company, right? Obviously, it's not like a guarantee, but it's a guarantee from my perspective, from the company's perspective, that you will have, I don't know, call it, let's say, $2,000 in 6 years, something like that, right? Or let's say, hey, if you pay me $1,000, let's say every month for the next year, I promise you, let's say $50,000 in 5 years, right? So it's very much like a zero coupon bond, very old-timey. All of the exams, they pretty much just want you to know that face amount certificates they're an investment company. That's really it from that perspective. I don't even know if there's many around nowadays, but yeah. Then the second one's going to be what's called a unit investment trust. Unit investment trust. So it's a trust that really has units in it. So it's created with a trust indenture, right? So, and they're not going to be called shares; they're called units. Versus like a closed end or an open end management company. So with the unit investment trust, it has a fixed. The two key points about it has a fixed portfolio, fixed termination. Fixed portfolio, fixed termination. So what does that mean? It means it's not actively managed. There's not going to be a 12b1 fee. Which is like a marketing and distribution fee, because you pretty much just kind of sell it once and then it matures. It is going to be supervised, the portfolio, but it's not going to be actively managed. And essentially, let's say you create a unit investment trust, you fill it up with various securities. I don't know, you throw some Apple, some Nvidia, some bonds in there, etc. Sometimes they're just bond UITs because it's kind of convenient in the sense because it's not actively managed, so it's going to be cheaper to have a bond portfolio. So you'll get a higher return if maybe compared to a mutual fund, or let's say. And essentially, it's just going to sit there, and it's going to, mature kind of like a bond or terminate at a specific date, let's say 5 years later. And then it's going to be a taxable hit. The investors are going to sell out. They're going to get their money back and plus more, ideally. And then the company's going to say, hey, you want to buy a new UIT that we're forming? And you're constantly just kind of going from one UIT to another, to another, to another. And if you want to get rid of it, you'd have to redeem it at net asset value. Net asset value, essentially just assets minus liabilities over number of shares. Assets minus liability over number of shares. I mean, it's the same formula as like shareholders' equity, owner's equity or stockholders' equity on the balance sheet, right? Now, management companies, this is the one that's way, 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 way more common than any of the UITs or FACs. That's split up into what's called open-end funds and closed-end funds. The defining characteristics of open-end versus closed-end is actually capitalization, right? So what's called a fixed capitalization or an open capitalization. A fixed capitalization would be like a closed-end fund where you raise the money once, you have an IPO, maybe you have an additional public offering or a follow-on public offering, and then it just trades on the exchange. So let's say if I believe that maybe my ability to raise capital was somewhat limited, I'd probably pick a closed-end fund, right? Now, if I believe that my ability to raise capital was unlimited, then I would pick an open-end fund, which is a mutual fund, right? A mutual fund basically has an infinite share formation. So they create shares and then they redeem shares, and then they can theoretically create as many shares as they want, right? They can grow infinitely if they wanted to, right? Mutual funds used to be very, 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 very popular. Nowadays, it got replaced with ETFs because ETFs are more tax efficient. So with mutual funds, they can have what's called fractional shares, right? It actually doesn't really matter how many shares you have. What matters is like a dollar amount, right? Mutual funds are the ones that have, the A shares, the B shares, the C shares. You have letters of intent. You have rights of accumulation when we're talking in the context of A shares. So yeah, you have an unlimited amount of shares. You can only issue stock, right? They're non-marginable. They require prospectus because it's always an IPO because you're always buying it from the issuer. It's always an issuer transaction. So mutual funds are what are called redeemable, right? Versus negotiable. Redeemable means you have to sell it back to who you got it from versus I'm going to sell it to John or Bill. You know what I mean? So closed-end funds, they trade on the market. They can have they can have bonds, they can have preferred stock, they have multiple share classes. You can buy them on margin, you could short them. Before, actually it's interesting, when the Investment Company Act came out in 1940, the only shares that could trade on the exchange were closed-end funds. Open-end funds were redeemable, FACs redeemable, UITs redeemable, right? So the only ones that could trade on the exchange were closed-end funds. Now, in the 90s, they came out with ETF, exchange-traded funds. Now, when they come up with new stuff, nobody wants to create new legislation. It's long, cumbersome. It's a pain, a really annoying process. So what they do is they literally just find the existing law and find a way to back into it, right? So the old ETFs actually started off, like I think the original ETF might have been SPY, right, that covers the S&P 500. Though those were classified as unit investment trusts because they usually track an index. They don't really change much, even though they change a little bit to match that index. And the newer ETFs are considered open-end funds, right? They're sort of like a weird kind of thing where it's almost like it's almost like considered a dog, but it behaves more like a cat in a way. Because when we think about open-end funds, mutual funds used to be the only kind of open-end funds. And with mutual funds, they don't trade on the exchange. ETFs do trade on the exchange, but with mutual funds, you have to just redeem it with the issuer. There is a similarity with ETFs is that they create new shares. They have like an in-kind redemption process, but not to go into too much detail there, but essentially the key differentiation aspect is the fact that open-end funds or ETFs can create new shares. They have an open capitalization versus a fixed. That's why they called ETFs open ends instead of closed ends, even though they're sort of more similar because they trade on the exchange, right? And then there's also there's stuff out there like interval funds or BDCs that are types of closed-end funds. Business development companies, they just pretty much function like private equity funds essentially, but they trade on the exchange. They usually pay a high income. Like I know someone who has an HSA and they keep it in a BDC, and essentially their income at this point from the BDC is enough to cover their premiums on health insurance, which is kind of cool, right? So that's a business development company. Then you also have interval funds, which are considered closed-end funds, but you can actually, they sort of behave more like open-end funds because you can only redeem them at intervals, with the issuer. Usually could be quarterly, could be monthly, could be annually. So that's essentially it in terms of investment companies. That's kind of like a high-level overview. So hope you listen for more, and please subscribe and like. Thanks so much.